The thing that's driving it is principally loss of faith in fiat currencies, and particularly the dollar. If you look at the trade-weighted index for the dollar, that's got what the technical analysts call a death cross, which basically is a very, very bearish sign. We had the death cross a week or two ago, and I think it's rather signaling that the dollar's trade-weighted will fall from around about 101 at the moment, probably through the 100, and then the next stop is around about 90. This is a very major move down. And in very, very uncertain times, normally you would expect funds to flow into dollars, but it's basically going into gold. And I think it will spread from that into other commodities.
It's no news that institutional investors are gradually losing interest in fiat currencies and fiat-based assets, particularly the ailing global stock market. In the United States, leading stock market indexes like the S&P 500 are being carried by a few good stocks, while the rest are performing well below expectations. This is probably why several iconic investors like Warren Buffett have been selling off their fiat-based investments in preparation for a coming widespread crisis. The legendary investor, popularly known as the Oracle of Omaha, currently has the market stomped with some out-of-character moves. Starting on July 17th, Warren Buffett began carefully orchestrating the sale of his company's substantial $1.03 billion share stake in Bank of America. In the 39 trading sessions from July 17th through September 10th, Buffett sold shares of BOFA on 27 occasions. This includes a streak of 12 consecutive trading days from July 17th to August 1st, and again from August 23rd to September 10th. In total, nearly 174 million shares have been sold, amounting to a market value of approximately $7.2 billion. This move has even the most seasoned market analysts scratching their heads, because financials have long been Warren Buffett's preferred sector for deploying Berkshire Hathaway's capital, and for years, Bank of America has stood out as his top banking investment. So, why the sudden sell-off? According to renowned metals analyst Alasdair Macleod, Buffett's moves can only be confusing for those who have not been noticing the writings on the walls for years. The debt-based fiat system is doomed and unraveling fast, spurred by the massive debts and excessive leverage in the system. Like Buffett seems to believe with his recent moves, Alasdair strongly believes the collapse will begin in the banking sector and spread swiftly through the rest of the financial system until it finally pushes governments to adopt a gold standard. We will present clips from Alasdair Macleod's latest interview with Liberty and Finance. Please watch, share, and like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
I mean, if I was looking at it from Warren Buffett's point of view, I'd be looking at the prospects for inflation and therefore interest rates. Now, we know that the headlines are full of interest rates are due to fall by 0.5% or 0.25% or whatever. But all this presupposes that the inflation problem is done and dusted, but it's clearly not. Also, if I was Warren Buffett, I'd be looking at international flows of capital and seeing that the foreigners are basically selling down the dollar, which will weaken the dollar. And if you look at what the dollar is doing, you can see that a weaker dollar is going to require higher interest rates to stabilize it. While, a little bit of a drop in the dollar you can tolerate and all the rest of it. And, the Keynesians would probably welcome a little drop in the dollar because it might support the economy. Ha ha. But you can see that there are a number of reasons why an assessment by a really experienced investor such as Warren Buffett might suggest that there's a lot of risk in the banking sector, more risk than the share prices would indicate. So on that basis, I can understand why he would reduce his holdings. The problem with interest rates, as far as the banks are concerned, is that it would reveal a huge, great quantity of bad debts. I mean, you've got all these zombie companies who have borrowed cheap finance when you had rates at the zero bound. And now, of course, they can't afford to refinance their position. It's just, they really are in an appalling position. And it's not just in America, this is all around the world. But the problem really is enormous for the banks because there are going to be huge, great problems. The banks presumably will require some sort of rescue if this really does deteriorate. And on that basis, do you really want to have all your eggs invested in a bank? I don't think you do. So I can understand why he's perhaps. It could be the reason that he's loosening up on his Bank of America holdings. I mean, I would certainly be reducing my position. The one thing I would say is that the idea that the Fed and the US Treasury would allow banks to go bust, and particularly major banks, is extremely unlikely. They will replace contracting bank credit by expanding government credit. So what happens is that your deposit in the bank may well be guaranteed, and I'm not talking about if the bank goes bust, there's, you get bailed out by sort of a massive joint fund. The problem, I think, is that your losses are going to be in the dollar rather than on bank credit being if you like, expiring, being not honoured. So that's the way I'd look at it. Banks will be rescued. I mean, we saw this when we had a number of small regional banks a bit over a year ago. There were no deposits lost. I mean, basically, the whole thing was engineered in such a way that they were taken over. The Fed stopped the run, if you like, on valuations by saying we will permit banks to value, their bonds at sort of full value, whatever they came up with means, if you like, to stabilize the system. They'll continue to do that, but it will be at the expense of the dollar. So that, I think, is really what depositors should be considering. Do they actually want dollars? Do they want deposits in dollars? Do they want credit measured in dollars, and dollars themselves at credit? So this is why I feel that the question they should be looking at more is, shouldn't we get out of credit and get into real money, which of course is gold? And this is part of the reason I think the fear factor is now driving the gold price higher.
According to the Congressional Budget Office, the massive increase in the federal deficit in 2024 was primarily caused by 4 factors. First was the $145 billion increase in projected outlays for student loans, stemming mostly from revisions the Biden administration made to the estimated subsidy costs of previously issued loans and the proposed rule to reduce many borrowers' balances on student loans. Second was the $70 billion increase in projected outlays for deposit insurance, because the Federal Deposit Insurance Corporation is not recovering payments it made when resolving bank failures in 2023 and 2024 as quickly as anticipated. Third and fourth were the $60 billion increase, resulting from some newly enacted legislation, and a $50 billion increase for Medicaid. Alistair warns that the deficit will only keep growing until the entire system collapses in on itself, leaving room for gold, silver, and other commodities to shine brightly. Let's get back to the video.
Well, on the supply and demand of physical, we know what's happening. Basically, the central banks are buying and the Asians are buying, and they're clearing out the market. Of particular importance is the Chinese consumer, who has a savings rate of roughly 35% of his income. That is huge. It's around about $6 trillion. The question is, where does that go? It's not going into property. It's not going into stocks. It's going into bank deposits. The rate on bank deposits is being reduced recently, so some of that on the margin is going into gold, and it's going into gold accounts at the banks. And it's the banks that are coming into London and effectively taking any loose bullion they can get their hands on. And so this has created something of a crisis within the paper markets, which we're seeing today. We have had a massive breakout on the upside for the gold price, and the swaps, who are bullion bank trading desks, are caught short. I mean, roughly the contracts on COMEX, you've got around about 530,000 contracts. The swaps are the largest portion on the short side by a long chalk, and consequently they are being squeezed. And I would not be surprised to find that they turn tail and are forced to buy back those contracts in a rising rising market for gold prices, which could actually accelerate the price of gold very, very rapidly. But other than that, really, the thing that's driving it is principally loss of faith in fiat currencies, and particularly the dollar. If you look at the trade-weighted index for the dollar, that's got what the technical analysts call a death cross, which basically is a very, very bearish sign. We had the death cross a week or two ago, and I think it's rather signaling that the dollar's trade-weighted will fall from around about 101 at the moment, probably through the 100, and then the next stop is around about 90. This is a very major move down. And in very, very uncertain times, normally you would expect funds to flow into dollars, which are seen as safety. They're not. They're flowing out of dollars, not into euros. Well, I mean, there's a little bit on the margin, a bare closing maybe, euros, yen, sterling, and so on and so forth. But it's basically going into gold. And I think it will spread from that into other commodities. We've had weak commodity prices recently. I think they've weakened too much. Silver has really caught a bid. That's been rushing up and has got a long way to go. I mean, looking at the moment, the gold-silver ratio is 84. It was 85.5 this morning. That should fall, I think, towards 70 and below, which tells me that silver is going to be a lot more powerful in its up move than gold. So, but it's being driven by gold. So the whole thing has got a developing air of crisis in the markets, I think. And I would go back to what I was saying about Warren Buffett's position. I mean, if you look at the inflation outlook, interest should not fall. They should actually be rising. But the problem is that the underlying economy, US economy, is not performing well. And I don't know whether you noticed this. I think it was yesterday, the budget deficit for August was released, and that was about $380 billion, about twice the level which it was during the COVID crisis, when there was no income coming into the government and accelerated payments out. I mean, this is a very nasty shock, and it tells me that the US economy has run into a brick wall.
Alastair explains that other economies, particularly the Chinese economy, are ailing as much as, or even worse than, the US economy simply because they are all currently on the same debt-based fiat currency model. However, there is a huge difference between the Chinese economy and the US economy and the rest of the Western world. The Chinese have realized the problem and have already embarked on a permanent, simple, and realistic solution. According to Alastair, the Chinese Communist Party has been accumulating huge amounts of gold for decades and probably has up to 30,000 tons of gold in its reserves. The analyst believes this gold will be used to restart the country's financial system after the global collapse, which will finally secure its place as a global superpower. Do you agree with Alastair MacLeod's assertions? Please share your thoughts and comments in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. We appreciate the support and hope to see you in the next one. Thanks for watching.